After making a huge fortune by investing in tech startup, Silicon Valley Bank invested most of its assets in US bonds. To bring down the inflation rates, the Federal Reserve last year began raising interest rates, which resulted in the bond values going down. Today, the SVB has been shut down and its assets have been seized. After the bank's closure, nearly $175 billion of customer deposits are under the FDIC, which claims that all insured depositors will have full access to their insured deposits. 89% though, remember, of the bank's $175 billion in deposits were uninsured as the end of 2022, and their fate remains to be determined. Joining us live, Dr. Jaijit Bhattacharya, President, Center for Digital Economy Policy Research. I want to get you in, Dr. Jaijit Bhattacharya, on why this happened, on how it happened over 48 hours, and why US financial watchdogs did not predict this. Where were they? Were they sleeping? Did they deliberately overlook this? Do they only look where it suits them? What happened in the span of 48 hours, according to you, Dr. Bhattacharya?
I think just the background, as Mr. Dua very illustratively pointed out, the bank did the right thing in terms of investing in the most secure of investments, which is government bonds, right? So you should not be going wrong in investing into government bonds. Now, let's also step back and see what happened in the last couple of years is to save America from the impact of COVID. About $5 trillion was spent by the government against an economy of about roughly $20 trillion, which means they spent 25% of their GDP on trying to save themselves from the impact of COVID.
Yes.
Now, somebody has to get the brunt of it. A lot of it got exported out because, dollar is a global currency. So countries like India ended up facing a lot of inflation, although we managed COVID very prudently in terms of financial management. But we got the hit of what US did because their inflation got exported out to us. Now, there will be a series of impact of the fiscal, I would say, imprudence of the US government on the US economy itself. And one of the impact clearly was inflation. And as Professor Nalapat mentioned, there has been very aggressive increase in the interest rates of the government bonds, which means that the bank had invested into the bonds when the bonds was giving about 1.5% or less than 2% of returns, and now it is about 3.1, 3.2% return on the same bonds. So when they had a run on the bank, they tried to sell these bonds. Now, why would anybody buy these bonds at the original rate? Obviously, there will be a discount to these bonds. And when you sell $20 billion worth of those bonds, you end up having a loss of about $2 billion. And what has happened is banking is also a business of sentiments and trust. By giving out the wrong signals very, very rapidly, people started to withdraw their money, the stock markets crashed, and both the news fed into each other. And it was almost a self-goal that the bank did. Now, coming to your key question, which is what were the US regulatory authorities doing? Did they see it coming or they didn't see it coming? Fact of the matter is there are other short sellers such as William Martin, who actually warned way back in Jan that Silicon Valley Bank is going to blow up. So if there are short sellers who knew that this is going to blow up, and there's estimated $500 to $700 million being made by short sellers because of the bank collapsing, then where was the regulatory authorities of US? And that's a big question. I clearly don't have the answer. It's a I would say a malfunctioning of the US regulatory structure in trying to protect such kind of a meltdown happening in the US economy. And unfortunately, this is not the end of it. In fact, a couple of days back, we also had the Silvergate Capital collapsing. So this is going to trigger more collapses as we move forward. And I think this is going to lead to not a very pretty situation. It's also going to impact India, by the way, because many of the, much of the money that was coming in through the venture capitalists, through the PE route and so on and so forth, they will get impacted because a lot of the money is actually locked in this bank, or it will be triggered. Their money will get locked, or there will be negative sentiments because of the fall of this particular bank. Now, It's not that the entire asset of this bank is gone. It was sitting on good assets, and that is going to get into what we call as in India as a bad bank. So they have created another bad bank called the Santa Clara Bank very, very quickly. And I think hats off for that lightning response in setting up a new bank to manage the assets of what has gone down. But your question still is valid as to why did they let it go down when it had the assets.
Yes.